Imagine an economy where interest rates stay near zero for decades, where the central bank can print money in huge amounts, where inflation barely wakes up, and yet the country remains rich, advanced, and globally important. It sounds impossible, right? But this place is real. It's Japan, one of the most financially mysterious countries on Earth. And at the center of Japan's economic puzzle lies a single tiny number. Daikei, the Japan 10-year government bond yield. Just a small percentage on a screen, but with the power to shake stock markets, move currencies, and redirect investment flows all around the world. In this video, we're going to slow everything down and explain, in simple everyday English, what the Japan 10-year yield actually is, why it stayed near zero for so long, why professional investors watch it like a hawk, how it affects the US, Europe, and even developing market, and what could happen next if Japan finally wakes up. Grab your coffee. Because the story you're about to hear is one of the strangest, most important, and most misunderstood stories in modern financial history. Let's start simple. What is a 10-year government bond? Before we talk about yields, carry trades, and global flows, we need a basic foundation. A government bond is simply this. You lend money to the government, though the government promises to pay you back with interest in the future. That's it. If you buy a 10-year Japanese government bond, often called a JGB, you are lending money to the Japanese government for 10 years. In return, they pay you interest every year, plus your original money back at the end. The yield is the yearly return you get, expressed as a percentage. So if the Japan 10-year yield is 1%, that means for every $100 or 100 yen equivalent you lend to Japan for 10 years, you earn about $1 per year in interest. Sounds straightforward, right? Now here comes the strange part. For more than 2 decades, Japan's 10-year yield stayed extremely low. Sometimes around 0.5%, sometimes around 0.1%, kombertainchid, tinlismero, sometimes 0%, bokopoli, hupke of devolution, and at times even negative, yes, negative. That means investors were lending money to the Japanese government and effectively paying for the privilege. Imagine putting $1,000 into a bond, and after 10 years getting back less than $1,000. Why would anyone do that? To understand that, we need to understand Japan's economic nightmare, deflation. Japan's lost decades, the bubble that never reflated. To see why Japan became such a strange country financially, we have to go back to the late 19th. Back then, Japan wasn't just rich. It looked unstoppable. Japanese companies were dominating global electronics and cars. Tokyo's land prices were insane. There are jokes that the land under the Imperial Palace was worth more than California. The stock market was soaring to record highs. It was a huge financial bubble in real estate, stocks, and expectations. Then, in the early 19th, the bubble burst. Asset prices collapsed. Real estate prices fell and kept falling. Stocks crashed and took decades to recover. Companies were suddenly over-leveraged, too much debt, and under-profitable. Banks were sitting on mountains of bad loans. This crash didn't lead to a quick recession and fast rebound, like we often see in the US. Instead, Japan entered something else. A long, slow era of weak growth, low confidence, and falling prices. Economists now call it the lost decade. But really, it turned into lost decades. Deflation. The enemy that keeps people frozen. Most countries are afraid of inflation, prices rising too fast. Japan's problem was the opposite. Deflation, prices falling over time. At first, lower prices sound good, right? Cheaper food, cheaper clothes, cheaper electronics. But in the big picture, deflation is poisonous. Here's why. If people expect prices to keep falling, they delay purchases. Why buy a car today if it'll be cheaper next year? If companies expect weak demand, they delay investment. Why build a new factory if people aren't spending? If profits are weak, companies don't give big raises. So wages stay flat. If wages don't rise, people worry about the future and spend even less. It's like the whole economy goes into sleep mode. Japan got stuck in this loop. And Japan's central bank, the Bank of Japan, BOJ, had to find a way to wake it up. 4. BOJ's big weapons, zero rates and massive bond buying. To fight deflation and weak growth, Japan tried something radical. First, they dropped interest rates to near zero. Zero interest rates. 0p. The idea was simple. If interest rates are low, borrowing is cheap. If borrowing is cheap, people and companies may borrow more. If they borrow more, they spend and invest more. That spending should help the economy come back to life. So Japan cut rates, and kept cutting, and kept them low. But the economy still moved slowly. So they tried something bigger. Quantitative easing, QE, printing money to buy bonds. Normally, central banks set short-term interest rates and that's it. Japan went further. The BOJ started buying huge amounts of Japanese government bonds from banks and investors. To buy these bonds, the BOJ created new money electronically, essentially printing yen. By buying so many bonds, the BOJ pushed bond prices up and pushed yields down. Why? Because when bond prices go up, their yields go down. So, more BOJ buying are higher bond prices, lower yields. Lower yields nor cheaper borrowing for the government, companies, and people. This was Japan's way of saying, we will make money so cheap that you'll have no excuse not to borrow, invest, and spend. Still, the economy didn't explode with growth. There was some improvement, but not a full cure. So Japan did something even more extreme. 5. Yield curve control. Japan grabs the steering wheel. In 2016, Japan introduced a policy that made financial history. Take yield curve control, YCC. Let's break that down very simply. The yield curve is a chart that shows interest rates for different time periods. 1-year bonds, 1-year bonds, 5-year bonds, 10-year bonds, 30-year bonds. Normally, markets decide these yields. Japan changed that. The BOJ basically said, we are not just influencing rates, we are going to control them. Specifically, it said, we will not allow the 10-year yield to rise above a certain level. At first, that level was around 0. Later, it was 0.1%, then 0.25%, then 0.5%, then around 1%, with flexibility. How did they enforce this? They promised to buy unlimited amounts of bonds if needed. If the market tried to push yields up, the BOJ would step in, buy more 10-year bonds, push prices back up, push yields back down. Think of it like this. The bond market is a balloon trying to float upward. The BOJ is a hand constantly pushing it back down. This was yield curve control. No other major central bank had tried it so aggressively. Japan was basically saying, we will not let our 10-year yield rise. We will keep it near 0 for as long as it takes. Why? Well, because higher yields, higher borrowing costs. And Japan, still fighting deflation and slow growth, didn't want that. 6. Why the 10-year yield in Japan matters to the entire world. Now you might think, okay, that's Japan's issue. Why should I care if I live in the US, Europe, or a developing country? Here's why. The Japan 10-year yield is like a quiet lever that moves huge amounts of money across borders. Let's walk through the main reasons. Reason 1. Japan is the world's biggest creditor. Japan doesn't just invest at home. Japanese investors, pension funds, insurance companies, banks, big corporations, and even individuals have trillions invested abroad. US Treasury bonds, European government bonds, corporate bonds, foreign stocks, real estate, investments in emerging markets. Why? Because for a long time, Japanese bonds paid almost nothing. Imagine being a Japanese pension fund. At home, 10-year bonds pay 0% or 0.2%. Abroad, US bonds pay 3%, 4% or more. Where would you invest? Exactly. So for many years, Japanese money flooded out of Japan, searching for better returns. Now here's the key. When Japan's 10-year yield is very low, money flows out of Japan into global markets. But when Japan's 10-year yield rises, money can start flowing back in. This matters because if Japanese investors sell US bonds and buy Japanese bonds, US yields could rise. If they sell foreign stocks and bring money home, global stock markets could fall. If they convert dollars back into yen, the yen gets stronger, the dollar weaker. So a small change in Japan's 10-year yield can create ripple effects across the whole world. Reason 2. The yen carry trade. Now we get to one of the biggest, most important financial trades on Earth. Take the yen carry trade. It works like this. Investors borrow money in Japanese yen at very low interest rates. They convert yen into another currency, dollars, euros, etc. They invest that money into higher yielding assets. US bonds, stocks, emerging market bonds, real estate, even crypto. You borrow yen at 0.25% and invest in something that pays 5%. You earn the gap. That gap is your profit, as long as the yen doesn't get too strong and your investment doesn't crash. Thank you so much for watching. Your support means a lot. This trade became huge because Japan kept rates so low for so long. But there's a catch. If Japan's yields rise or if the yen suddenly strengthens, this trade becomes dangerous. Investors may rush to exit. They sell their foreign assets, convert money back to yen, repay their yen loans. This unwinding can push stock markets down, push other countries' yields up, make the yen jump in value, tighten global financial conditions. So when you see Japan's 10-year yield rising, Wall Street isn't just curious, it's nervous. Because the carry trade starts to shake. Reason 3. Japan was the last ultra-low rate holdout. After 2020, the world changed again. COVID happened. Government spent huge amounts to support economies. Central banks slashed rates to zero. Then inflation came roaring back in 2021-2022. The US Federal Reserve reacted by raising rates sharply. The European Central Bank did the same. Other central banks followed. But Japan? Japan kept rates near zero. While other countries moved away from cheap money, Japan stayed stuck there. This created a massive imbalance. Global investors were watching one big question. How long can Japan stay different? Because once Japan starts to move in the same direction as everyone else toward higher yields, the adjustment can be violent. Japan's inflation surprise, the economy wakes up. For many years, inflation in Japan was like a ghost, always talked about, rarely seen. Then, after 2022, something changed. Prices began to rise. Energy costs went up. Global supply chains were disrupted. Companies started raising prices. Workers began demanding higher wages. For the first time in decades, Japan saw meaningful inflation, not hyperinflation, not crisis levels, but enough to be a big deal in a country used to flat prices. Suddenly, the old strategy, permanent near-zero yields and super cheap borrowing, looked risky. Because if inflation goes up and yields stay too low, the currency can weaken. Savers lose more purchasing power. Foreign investors lose interest in your bonds. Financial imbalances grow. So the Bank of Japan had to adjust slowly, carefully. They didn't want to crash markets. They didn't want to kill growth. But they also couldn't keep pretending nothing had changed. 8. The BOJ starts to shift. Tiny moves, huge signals. Here's what the BOJ did over time. It raised the ceiling on the 10-year yield. From around 0.25%, 0.5%, 1%. It began talking about greater flexibility in yield control. It signaled that, over time, Japan might allow higher yields. To an ordinary person, a move from 0.25% to 1% may sound tiny. To financial markets, it's like a thunderclap, because it doesn't just mean, hey, the yield is 1% now. It also hints, Japan might slowly leave the ultra-low yield world. And if Japan leaves that world, global finance has to recalculate everything. 9. How this affects you, even if you don't live in Japan. You might be thinking, I don't own Japanese bonds, why should I care? Let's connect this to everyday things you might care about. Your stock market investments. Your support means a lot. But if Japan's yields rise, Japanese investors may sell foreign stocks and bring money home. Global investors may adjust portfolios based on new interest rate expectations. Risky assets like tech stocks can feel pressure. Result? Dive spat. Stock markets can fall, even outside Japan. The U.S. Treasury market. Japan is one of the biggest foreign holders of U.S. Treasury bonds. If yields in Japan rise enough to become more attractive, Japanese investors might reduce U.S. bond holdings. Currency exchange rates. If Japan's 10-year yield rises and markets expect more tightening, the yen can strengthen, the US dollar, euro, and others can weaken against it. That affects exporters, importers, tourists, investors with foreign incomes or obligations. A stronger yen also makes Japanese assets more attractive to foreigners, and foreign assets less attractive to Japanese investors. 10. Why Japan could do what others couldn't. Here's another big question. How did Japan manage to keep yields so low for so long without a full-blown crisis? Several key reasons. Strand 1. Aging population. Japan has one of the oldest populations in the world. Older people spend less, borrow less, save more. That naturally keeps inflation lower and reduces wild swings in demand. 2. Cautious consumers for watching. Your support means a lot. Japanese culture tends to lean towards stability and caution. People prefer secure savings, safe jobs, predictable lives. This reduces the kind of aggressive borrowing and speculation you see in some other countries. 3. Government debt owned at home. Japan's government debt is enormous, more than 260% of GDP. In most countries, that would scream crisis. But in Japan, a huge portion of that debt is held by Japanese institutions, Japanese banks of Japanese pension funds, the Bank of Japan itself. That makes the situation more contained and reduces the risk of sudden foreign attacks on the currency or bond market. 4. The BOJ's giant balance sheet. The Bank of Japan has bought more than half of all Japanese government bonds in existence. That means the central bank itself is holding a massive amount of its own government's debt. The BOJ isn't going to panic sell those bonds. It is the market. That gives Japan room to manage things in a way other countries can't easily copy. 5. Political and social stability. Japan rarely swings from one extreme policy to another. Changes are often gradual, cautious, and heavily discussed. There are fewer sudden shocks. That stability, political, cultural, and social, gives their central bank more freedom to experiment. 11. What happens next? Possible futures for Japan's 10-year yield. Now we come to the big question. Taikeo, what might happen next? Let's walk through 3 main scenarios. Scenario 1. Slow and steady rise, most likely. In this path, Japan lets the 10-year yield rise slowly, maybe toward 1.5%, then 2%, over several years. The BOJ keeps some control but gradually relaxes YCC. Inflation stays moderate, not too high, not too low. The impact: the yen likely strengthens over time. Japanese money returns home little by little. US and global yields drift higher. Stock markets see periodic corrections, not total collapse. The yen carry trade unwinds in stages, not overnight. This is the soft landing version. It would still be bumpy, but not necessarily catastrophic. Scenario 2. Sharp jump in yields. High stress scenario. In this scenario, something forces Japan's hand. Inflation jumps unexpectedly. Global pressures force BOJ to move faster. Markets lose patience with ultra-low yields. So BOJ allows the 10-year yield to spike more quickly. The impact: bond prices drop sharply. Japanese banks and institutions holding low-yield bonds face losses. Investors unwind yen carry trades aggressively. Stock markets in Japan and globally could sell off hard. Currency markets move violently, yen surges, others weaken. Risk assets like tech stocks and crypto feel strong pressure. This is the scenario that makes hedge funds and central banks very nervous. Scenario 3. Back to near zero. If inflation fades again. It's also possible that global conditions soften. Inflation in Japan drops back down. Growth slows again. In that case, BOJ might step back from tightening. Yields could stay low or go lower. The old pattern of ultra-cheap Japanese money could continue. This would calm some global worries, but also keep all the old imbalances alive. 12. But Japan's tightrope, high debt, thin ice. Why is Japan so cautious? One word: debt. Japan's government debt is massive. If bond yields rise too fast, the government's interest costs explode. More tax money goes just to pay interest. Less money is available for services, social security, investment. Banks and pension funds holding low-yield bonds might also suffer big losses if yields jump and bond prices fall. So Japan is walking on thin ice. Move too fast, risk financial instability. Move too slow, risk inflation getting out of control or currency weakness. The result? Everything Japan does is deliberate, slow, and heavily managed. 13. The whale in the lake. A simple analogy. Here's an easy way to picture it. Imagine global finance as a huge, calm lake. On this lake, every country is like a boat. Some are big, some are small. Most of them move around, creating small waves. Japan is different. Japan is not a boat. Japan is a whale resting quietly under the surface. For years, the whale barely moved. Its yields stayed near zero. Its policies were ultra-stable. It didn't send big shockwaves, but when the whale does move even a little, the entire lake shakes. US markets move. European bond yields shift. Currency markets jump. Hedge funds scramble. Central banks adjust their strategies. That's how important Japan's 10-year yield has become. 14. What smart investors watch, so you can watch too. Professional investors know how powerful Japan's bond market is, so they constantly monitor the BOJ press conferences. Tack with the Huisk conferences your person to ready many polis, pekami level person like action. Thank you, like parta mulch first. And we see how forstel but verschweigt. Remember the Huisk conference heskmais, which peeping to batchen mulch for die. FCA's updates on yield curve control. Japan's inflation data. Wage negotiation results in big companies. The yen exchange rate versus the dollar and euro. Results of Japanese government bond auctions. A move of just 0.1% in the 10-year yield can signal a policy shift, a change in BOJ's thinking. A new direction for global money flows. You don't have to be a trader to pay attention. Even as a long-term investor, understanding this helps you see why global markets behave the way they do. 15. So what should an ordinary person take from all this? Let's strip away all complexity and ask, what does this really mean for you? Here's the core message. Japan's 10-year yield looks tiny, but behind it stands 30-plus years of economic struggle, the world's most extreme experiment in low rates and bond control, one of the largest pools of investment capital on Earth, a central bank willing to do what others won't. When that tiny number moves, it tells you something about Japan's future. It sends signals to global bond markets. It changes how professional investors position money. It can quietly affect your stocks, your currency, your borrowing costs. You don't need to memorize every detail. But you should remember this. Tech Japan is not just another country. It is a silent giant in the world of money. And its 10-year government bond yield is like its heartbeat. When that heartbeat changes rhythm, the entire global system feels it. 16. Final thoughts. The quiet power of a small number. The Japan 10-year government bond yield might show something like 0.3%, 0.7%, but family tarbas hente board of Kintio Evitspelsteen point. 1.0%. These are small numbers. But behind them are trillions in decisions. Should Japanese pension funds keep money abroad or bring it home? Should hedge funds keep borrowing yen or unwind their bets? Should the BOJ keep controlling yields or step back? Should global investors treat Japan as the land of zero rates or as a normal market again? Japan's bond market is quiet but powerful, silent but influential, sleeping but capable of shaking the world if it really wakes up. So the next time you read a headline like, BOJ allows 10-year yield to rise by 0.25%, don't scroll past it. That tiny change might be the first sign of a big global shift. Because in modern finance, sometimes the smallest numbers carry the loudest messages. If this opened your eyes to how Japan quietly shapes global markets, hit subscribe. History, money, and power are always connected, and I'll be here to show you where to look next.